What's up everyone and welcome to the channel. On today's video, I'm basically going to provide you guys with a course for free on YouTube on the stock market and how to get started investing in the stock market. We're going to go over so much in this video, so it's going to be lengthy. Check the chapters down below, the timestamps, and jump around if you want to. If you're new to this channel, my name is Sean. I've been running this channel for 2-3 years. We have a Patreon, a community of investors and traders, and I have very good knowledge regarding the stock market, how the stock market works, and I am able to provide you guys with some value. At least I think I am. So if you're interested in more content regarding stocks and the stock market, then definitely consider hitting that subscribe button and ringing that notification bell so YouTube notifies you when I upload a new video. But with all that being said, let's get started because like I said, there's going to be a lot of information. So to get started, why even invest in the stock market? Why are we talking about this? Why do people put their money into the market? What are some of the reasons why people invest in the stock market? Well, probably the biggest reason is because the stock market has a very good history of performing well over the long term. On average, it's around 8 to 12% annual return stretched out over the long term. That doesn't mean that every year you should expect those kinds of returns. Some years you could get 20-25% returns. Some years your portfolio can get cut by half. But over the long term, if you average that out, it's around 8 to 12%. Certain periods are better than others, depends on a lot of different things, but that's the average. And if you take a look at this chart, which is for the Dow Jones Industrial Average, and this goes all the way back to when it was started, which was February 1915 at $1,600 for the index, and the current price is just under $34,000. Now, obviously, there's a ton of inflation that has happened over that time, but you can see that over the long term, it's up and to the right. This chart is. Now, we have peaks, we have values, there's a lot of volatility, but like I said, average over the long term, very strong history of providing good performance for an individual. Another reason is because it has a very low cost of entry. Basically, anybody can get started investing in the stock market. You don't need tens of thousands of dollars to do so. You can do so with just $5. So, unlike real estate or trying to open up a business where you're going to need a lot of money, investing in stocks is really easy and you can do so with very little money down. That's why it's usually the first step somebody takes when thinking about investing. Another reason people invest in the stock market is because of what's known as compound interest, which is your money grows over time and that interest compounds. And as you get towards retirement or towards that time where you're going to take your money out, it is growing exponentially. So you're going to see a lot of growth in the later years, which is very beneficial because that's when you get closer to retirement. So if your initial investment, let's say we were to do this for a Roth IRA with which has the current max annual contribution limit of $6,500. So that's our initial investment. Our monthly contributions to get to $6,500 a year would be around $540 a month. For the length, let's assume that you open this account when you're 20 and you pull everything out when you're 60, so 40 years. The estimated interest rate, like I said, anywhere from 8 to 12%. So we'll just do 10%. We'll do 0% in variance. And this is going to compound daily. So this person would have in 40 years an account worth $3.8 million just by putting in $6,500 a year. This is what they would have. And because it's a Roth IRA, their capital gains are not going to be taxed as long as they follow the proper protocol set by that Roth IRA. Capital gains, as you can see by this chart with your returns, they really start to move higher towards the end of the cycle. So if we go right to the middle of the cycle, we're at $461,000, which is far less than half of $3.8 million. Now, if we were to extend this from 40 to 45 years and we were to calculate, now we're at 6.3. See how it really starts to jump towards the end. The longer you have your money in, the more it can compound and the higher returns are going to be. And you're going to see a lot of that growth towards the end, towards retirement. Another reason people invest in the stock market is because it can be beneficial tax wise. If you have your money in account like a Roth IRA, like we stated for this example, this $6.3 million in portfolio value, a lot of that's going to be capital gains. If you hold it based on the requirements for the Roth IRA, when you take it out after retirement, you are not going to be taxed on those capital gains. Other tax advantages include if you have a taxable account and you were to sell stock, you can withdraw those losses or deduct those losses from your tax filings. In addition to that, if you hold a stock for more than 12 months, it is considered long term capital gains and you are taxed less than income. So that is beneficial to you as well. And another reason people invest in the stock market is because it is considered liquid in most cases. If you have your money in a taxable account, you can withdraw that money basically whenever you want. So you have access to it. It is not tied up like if you were to have your money in some kind of bond or CD or rental property, which would take a lot more time for you to sell that property and actually see that cash. With the stock market, it is very liquid and easy to obtain. So, what exactly are stocks? Well, stocks are also known as shares and they're also known as securities. So, when you buy a stock, you are owning a common share or some kind of share of a company. So, you are part owner of that company. You are what is considered the shareholder. Now, back in the old days, you would have to go to the New York Stock Exchange and you would get this stock certificate that would show that you are the owner of 100 shares, 100 common stock in Coca-Cola. Now, if Coca-Cola was to continue to be a successful company 10 years down the road, in theory, the market would price these 100 shares at a higher price than you bought them for. You could sell it and make that difference, and that would be your capital gains. If Coca-Cola ran into some hiccups, the economy was in a downturn, sales were not performing as expected, then the market might value these 100 shares for less than what you bought it for. You can hold on to those shares or you can sell them, and that would be at a loss. But either way, when you own these shares, you are considered a shareholder. And a lot of shares give you voting rights to matters that are presented by the board. For instance, there are certain things that the board needs approval from the shareholders. You will get a letter, you will be notified on how to vote, and you have the right to vote. So your say does matter. When you buy stock, you are buying part of a company. You are becoming part owner of that company. Now, as part owner of the company by owning shares, you also receive some of the profits, or you can receive some of the profits. Companies can do this two different ways. They can do share buybacks and they can give you a dividend. When they pay a dividend, that is coming out of the profits and it's going directly to you as a shareholder. When they do buybacks, they are buying back shares. So every share that you own now is worth more of the company on a percentage basis. And it should increase the amount for that share that somebody's willing to pay. Those are two ways a company passes on profits to its shareholders. Another way is through performance, and this is indirectly. As a company performs better and people are willing to pay more for that company, you are seeing appreciation in the share price and you could sell and collect those gains. Now, you might be thinking that, man, this is really cool. I would love to buy some Chick fil A, some Wawa, because I eat there all the time and I love those companies. How do I buy stocks in those companies? Well, you can't because stocks are only for publicly traded companies. And publicly traded companies are formed through an IPO, direct listing, or a merger. There is a step that converts them over from a private company over to a public company, which then allows you to buy shares in that company. So the way that it usually happens is through what's called a traditional IPO. An IPO is an initial public offering. And what the company is doing, it is offering shares to the public. The public buys those shares. There's underwriting process that's done by an investment bank such as Goldman Sachs. They come to a conclusion on what those shares would be worth. People buy those shares, institutions buy those shares, investment banks own some of those shares, and the shares become publicly traded. The money from that initial public offering is given to the corporation because they just sold off some of the corporation to the public, and it goes to their balance sheet. It can be used to pay off debt, it can be used to help grow the company, it can be used for many different things. It's up to the company what they do with it. But now the company is publicly traded. So they have to do annual filings with the SEC. They have to do quarterly filings with the SEC, which are 10Qs. The annual ones are 10K. And there are other forms that they have to follow. They have different accounting principles and they are held to a much higher standard given that they are now a publicly traded company. The benefit to the corporation is that when they are publicly traded, if they perform well and the market moves higher, that gives them more flexibility. It allows them to take advantage of this and sell some more stock, collect some more money to help even further grow the business. It helps them stand out from the crowd, get more investors involved, which helps drive the price higher, which helps reward management employees through stock based compensation. And there are many different things or many other benefits for being publicly traded. The downfall is if you don't perform, if you're not on your game, then you are going to be punished and you're going to see your stock price fall, which it wouldn't have done so much if you were privately traded, if you were a private company. Your books are not under as much scrutiny. You're not in the public eye. So things are much more laid back as a private company, but you don't have that benefit if you do everything right and you perform top notch. Now, there are different ways that you can start investing in the stock market. The easiest way is through a 401k, which is probably going to be provided by your employer. So, and there's probably going to be a match that I highly recommend you take advantage of that. That is going to give you access to the stock market through funds, and you're going to be well diversified investing in the overall market, which is actually a good thing for long term growth. You can also have what's called a 457B plan, which is just a compensation plan for a government employee, just like a 401k essentially, but slightly different. Another way you can get invested in the stock market are through IRAs, and there is a traditional and a Roth IRA. A traditional IRA grows pre-tax, so you don't pay taxes on the money when you put it in the account. You're going to pay taxes when you withdraw it. A Roth IRA, you're taxed on the money up front and then it grows tax-free. I myself am a fan of Roth IRAs. I personally have one with Interactive Brokers. If you want to open one up, you can do so. Click on the affiliate link in the video description to get your account situated. Another way you can get invested in the stock market for your children is what's called a 529 plan, which is a college savings plan. This is going to allow you to invest in the stock market for a beneficiary. And with this 529 plan, when you withdraw the money basically for educational purposes, you don't have to pay taxes on it. So it's a very tax beneficial program for educational expenses and some other stuff included. And then the most common way people get started investing in the stock market is through a taxable brokerage account. There are many different brokerages out there. You can use TD Ameritrade, you can use Interactive Brokers, you can use Charles Schwab, you can use Fidelity, you can use Webull. I personally use TD Ameritrade, Interactive Brokers, and Webull. Interactive Brokers and Webull. There are affiliate links down below. Webull currently has a great offering right now where if you open an account and deposit $100, you'll get 12 free stocks valued up to 30,000. Yes, 30K just by opening an account with Webull today. An affiliate link is provided in the video description down below. Now, there are primarily 4 different types of stocks, and we'll go over every single one of them in little detail. The first one is what's called an index fund, and this is buying the S&P 500, the Dow Jones Industrial Average, the Russell 2000, or the Nasdaq 100, or a different index. Basically, you are buying a basket of stocks. You are buying the index. This is a common way to invest for the long term, gives you diversification. You are going to be investing in the top companies every single time because those top companies are going to be in the major indices. And it's an easy way to get started. Another way to invest, which is somewhat similar to index funds, but a little bit different, are mutual funds. They can be more specialized on a particular basket of stocks, and they are actively managed by a fund manager. So there's going to be some fee associated with mutual funds. Definitely worth looking into because sometimes those fees eat into the performance and you're better off just buying an index fund anyway. Another form of investing can be done through exchange traded funds, which is very popular. They're known as ETFs, and these can get very specialized. You can buy an ETF basically on anything nowadays. So if you wanted to buy an ETF that just, I don't know, was just focused on water companies, there's an ETF out there that is just water companies, just solar stocks. You can find that ETF as well. There are ETFs out the wazoo nowadays. Now, there are fees associated with ETFs. They're typically lower than mutual funds, and they provide great flexibility, and it's the preferred way of investing if you are not doing index funds most of the time when comparing mutual funds to ETF. And then the other way is just to buy a stock in a company. You can buy just Apple stock if you wanted to. You could just buy Google stock. You can buy whatever company is publicly traded. You could just buy that company if you wanted to. Next, let's go over how to buy stocks. So, once you have an account set up, whether it's a taxable account, a Roth IRA, a traditional IRA, or if it's through your 401k, it's going to be done automatically. But let's say that you have a Roth IRA, which is what you're seeing right here, and you wanted to buy stocks. Well, you would log on to your portfolio and then you would pick the stock. Now, this is an ETF. This is the SPY, and this follows the S&P 500 index. So I'm getting exposure to the overall index through an ETF with low fees. So if I wanted to buy it, you log onto your brokerage. The process is going to be very similar for all of them. The user faces are going to be slightly different. You would click buy. Now there are 2 different order types. There is a limit order and a market order. So a market order is basically you telling your brokerage that you want to buy this stock at market price during market hours. So it doesn't matter what the price is. Let's say it's 404.73, but the broker can't get an order filled until $405. Well, you're okay paying that price because you have market selected. A limit order is basically you telling the brokerage that you're not willing to pay more than an X amount for one share. So in this case, you could set your limit price to $3.99. You think it's going to come down a little bit. You don't want to buy any shares until it gets to $3.99. Once it hits that price or lower, you have the okay from you give the brokerage the A-OK to go ahead and buy some shares at that price or lower. Obviously, get it for the best price possible. Another way you can buy shares, and not every brokerage is going to offer this, but Interactive Brokers and Webull does, is you can buy a fractional share. So instead of buying 100 shares, I can specify a dollar amount. So let's say that I still want to buy it at $399 or less, but I don't have $399 to buy one share. So I am willing to buy $150 worth. So as you can see, what I'm going to do is I am going to be purchasing 0.38 of a share. So just over a third of one share for SPY. This is what's known as fractional shares, and this goes to the point of a very low cost of entry. With just $5, I can buy a fractional share of many stocks out there depending on my brokerage. I don't need a lot of money and I can do this frequently. Some brokerages will even allow you to set a scheduled contribution. Let's say every single month on the second day of the month, you want to buy $100 worth of whatever stock you pick. You don't care what the price is. Just do this like clockwork over many years and accumulate a position. Now, how do you research a stock? How do you look to see if the stock price makes sense and if it's a good buy or not? There are many ways you can do this. The first way is what's called fundamental analysis. There's two ways you can do this. You can do it top down or bottom up. Now, top down is basically your overall look for the economy. So if you think the economy is going to be crap, then probably don't buy stocks. Bottom up analysis, you look at a specific stock first, then sector specifics, and then the economy status. So this is a little bit different than top down, and they both are considered fundamental analysis. Now, there are quantitative and qualitative aspects when looking at fundamental analysis. Quantitative is going to be the three sheets that come from annual or quarterly filings: your income statement, your balance sheet, and your cash flow statement. This is going to give you the rundown of the company. It's going to tell you how much money they're making, how much money they're spending, how much money they have on the books, their debt to liability or their debt to asset ratio. And it's going to show you, if you collect these over time, how the company is growing. The qualitative stuff includes brand recognition. How strong do you think the brand is? Does the company have a moat or some huge advantage compared to its competitors? Is the business model sound? Do you see that there is avenue for future growth? And what is the corporate governance like? Is the board continuously selling shares and hurting you through dilution? Is the CEO on top of his game or not? Is it a company you are willing to invest in? And do you see future growth based on the fundamentals? The other way you can research a stock is through technical analysis, which in a nutshell is you're letting price dictate what a stock is worth. You're looking at patterns, you're looking at support and resistance lines, and basically what they are showing you is when buyers are coming in and when buyers are selling. You're letting prior price performance dictate what you think a good entry is in the future. That is technical analysis in a nutshell. I personally use fundamental analysis and technical analysis when researching stocks for investments and trades. Fundamental analysis works for the long term, 5 years out, because fundamentals will eventually drive share price. Technical analysis is good to help get you into entry positions, when to trim trades, when to trim the overall position, when to be more nimble, and things like that. It's not used for long term performance because technicals can change very rapidly, but fundamentals are going to stay more sound. Another way you can analyze a stock is through market multiples. So for instance, what we're looking at right now is the S&P 500 price to earnings ratio, which is a multiple. And as you can see right now, it's at 21.63. And as you can look in the past, we've been much lower, and during bubbles, we've been much higher. This can help give you a gauge on if a stock is overvalued or undervalued. You can go to a website like Seeking Alpha, click on a stock, go to the valuation page, and here it's going to tell you the price to earnings 5 year average and where it's at right now. So, price to earnings gap forward looking for Apple is 25. Its 5 year average is 23.27. So Apple, based on this market multiple, would be slightly higher than its 5 year average. So it's not cheap, it's not super expensive. It's kind of at its average based on future earnings projections and the current price for the share. And another way would be through quant ratings, which is basically very convoluted. It's through valuations, it's through algorithms, it is all computer based, heavy calculations. And a quant rating will tell you if a stock is a hold, a buy, or a sell. And it will also give you a strength. And Seeking Alpha has its own quant. And as you can see right now, Apple is a hold at a 3.33. Different companies have different quant ratings. This is just one example. Now, to sell shares, it's very easy. You can do so relatively quickly. The process is very similar to buying stock. So I own 11 shares of GLD, which is the Spider Gold shares. On my Roth IRA, I would hit sell. Now, the same thing, a limit or market order. Tell me the minimum price that I'm willing to sell these shares for. So if the stock is currently at $172, I can say, I want to hold on to this just for a little bit higher, but sell it at 175. And you can do the quantity or the US dollars, or you can do the market price, which is you telling your brokerage to sell however many shares right now. I don't care what price it takes to get the order filled. You can also do it through a stop loss. So basically, you can tell your brokerage during market hours, these only get filled during market hours, but if the stock was to fall to $170, please sell my shares because I think based on technical analysis, that is breaking through a support and there's a lot more downside risk. I don't want to own the stock below 170. So try to get that order filled, please. You can do that through a stop or a stop limit where you would then tell the price for your brokerage to then sell the shares. Now you have to be mindful when you sell stocks, is it short-term or long-term capital gains because you are going to be taxed differently. For your long-term tax bracket, let's say you're anywhere in this $40,000 to $455,000 in annual income for a single person, you're going to be taxed at 15%. For short-term capital gains, if we pull this up, if you're at that 44 to 95, you're at 22%. So you're an extra 7%. If you're at 95 to 182, 24%. And you go all the way up to here. We were at that 445,000. So right around here, you can be at 35% compared to 15%. So there is tax benefits to holding a stock for long term, which is 12 months, a year. Another thing you have to be mindful of is when you sell a stock, you can't just go around and buy it again because that is considered a wash sale and there are consequences to that. A wash sale bars the taxpayer from deducting the loss on a sale of a stock that they replace within 30 days. So let's go over an example here. Let's say over the last 10 trading days, you bought Apple stock every single day. You bought it, sold it every single day. And 5 out of 10 of those days, you made $100 in profit. So you made $500 in total profit. But the other 5 days, you lost $100. So you lost $500 in total. So in theory, you didn't make any money off of those trades. You're at zero. You made 500, you lost 500, zero. But that's not what you're paying taxes on because of the wash sale rule. You're paying taxes on $500 regardless of the fact that you actually didn't make money. So yes, that is a huge issue. And actually, if we look this up, there's an actual case out there during the whole day trading frenzy during COVID where somebody on Robinhood had a $800,000 tax bill despite only making $45,000 in net trading profits. Imagine that. That's because of the wash sale rule. So when you sell a stock, don't just turn around and buy it. Do not become a high frequency trader and be mindful of that wash sale rule. Now, what are some of the biggest mistakes somebody makes when investing in the stock market? The most common one and the hardest one to achieve or conquer is controlling your emotions. Whenever money is involved, people become irrational and you make decisions that aren't necessarily best for you and your portfolio. So, controlling your emotions and not getting too emotional is very hard to do, but is crucial when investing and trading in the markets. Another mistake that's very common has to do with greed and FOMO, fear of missing out. You buy something because it's being hyped up and it's at prices that are just not reasonable, and you end up buying close to the top and then it tanks and you're left holding a massive bad. This is because you had fear of missing out. You thought that this thing was going to go way higher. You had some greed because you wanted to make money. So those two things played against you and you made a decision that was not smart. So do not be greedy and do not be afraid of missing out. There's always opportunities out there. It's better to be early than it is to be late. Another common mistake is that you get your feet wet, you have 1 year's experience, and you've been pretty good on some trades, and you're starting to feel confident. So the next trade that you go in, you've done your research and you go heavy on that trade. You're too confident and now you lack diversification and discipline. You have too much weight behind one given trade. That's the trade that usually goes against you and undoes all of that work that you have had done over the last year and completely kills any progress you have made. Do not get too confident in yourself. Always second guess yourself. You are going to be wrong a ton when investing in the stock market, and maintain some discipline and diversification. Another common mistake people make is they think that the stock market is a way to get rich quick. And I can guarantee you that that is not the case. Now, if you need any help getting started investing in the market, you can definitely join our community. The Patreon is listed down below. It's only $5 a month. There's a price there for a reason, to keep out scammers, and $5 a month I think is extremely cheap and it provides value. So if you want to join the Patreon, a link is down below in the video description, and it will give you access to a Discord server, which will then give you access to the community where we go over stocks, where we go over market conditions, we go over potential opportunities. There's a library of books and resources for you to get more knowledge. And there's that community where you can ask questions about the overall market. Outside of that, you can also start paper trading. You can start paper trading on Webull or Interactive Brokers. This will allow you to start filling orders with fake money to get your feet wet on the whole process before you actually start investing or trading your own money. You can use websites like Seeking Alpha to read articles, to keep up on news, to read what other people are saying about given stocks and market conditions. You can use websites like Yahoo Finance to take a look at valuations, market multiples. You can do that on other websites as well. But yeah, that pretty much wraps it up for this video. I thank you so much for your time. Any questions, comment down below. Feel free to hit that subscribe button and ring that notification bell. I thank you so much for your time. This is We Are Investing, and together we are invincible. See ya.